What a year 2021 has been. Some companies, some sectors have pushed towards new heights, while others, whether as a result of the broader macroeconomic environment or internal company struggles, have really struggled and traded into headwinds. Today, in the spirit of Boxing Day, a day where there's plenty of sales, potential bargains, and people like to head out and go for a shop, I thought we'd discuss some of the companies that have really struggled on the ASX as some of the bottom performers in 2021 and explore whether there are potential opportunities with these companies or whether they have more systemically embedded issues that they may have to work through moving forward. It's a fascinating time. Hope you had an amazing Christmas period. I'm wishing you, your family and friends an amazing New Year period as we head into and look forward to 2022 up ahead. If you do enjoy this video, don't forget to hit the like button. Feel free to share it out. If you're new here, welcome. We make daily videos each and every day. So make sure you've subscribed and turn your bell notifications on so you won't miss any of our daily episodes. As you can see here, having a look at some of the struggling performers on the ASX 200 and 300 indexes across the past year. There are some names that I'm sure you're familiar with, from Nuix to Magellan, Kogan, Appen and Sezzle. Many of these names have struggled either throughout the year or for individual periods. For example, MFG is a company that struggled more recently, with their CEO leaving and then, of course, losing one of their headline clients and the consequent downgrade to potential forecasted revenue. While there are other companies like Nuix or A2 Milk that have had longer term struggles throughout the past year. And so it's going to be interesting to see how it plays out. I'm keen to know your thoughts on it all, so drop in a comment below. With this list of companies that have struggled throughout 2021, do you see any opportunities for potentially basement buys as they look for a pathway towards recovery? Or do you think more of these issues are more systemically embedded and may take longer to work through? As you guys know, I'm not a financial advisor. Nothing we discuss on the channel is financial advice. The stocks we discuss are not buy recommendations. These are all just general discussions to be that starting spot for you to go away and do your own research from. It's a fascinating list. 2021's been an interesting year with a lot of different curveballs and, of course, a lot of natural difficulties to work through as companies try to navigate the pandemic, lockdowns, potential reductions in growth and demand for their products, and now companies are able to look forward and try to get back to a more of a new normal type of operating condition. So stock number one, A2 Milk. ASX A2M has really been a true poster child for a growth stock darling over the past few years. It's been growing at 20, 30, 40% year on year. But of course, with the pandemics and the lockdowns, and then the Daigao channel having some difficulties due to disruptions from border closures and reductions in mobility, A2 Milk's primary channel through the Daigao channel was affected, and there was a consequent reduction and effect on revenue and ultimately profitability. We can see here, having a look at the list, increased distribution costs from increased warehousing. There was stock write-downs as well, and investors are really looking for the Daigao resumption and further diversification through other channels as well. It's going to be a fascinating period. A2 Milk has lost nearly 75% or 3/4 of its value from its all-time highs, but investors are looking to see whether they can get a resumption back into their growth trends that they came into the pandemic with and seeing if they can return to those lofty heights. Appen. ASX APX is another one that's been a technology growth stock darling on the ASX. One of the 5 wax stocks, which is the ASX equivalent of the FANG stocks with WiseTech, Afterpay, Appen, LTM and Xero. Appen has continued to move higher and higher over the past few years. However, during the pandemic, they experienced some difficulties and some headwinds to navigate into. Firstly, of course, the Australian dollar and US dollar trade-off went the wrong way for ASX APX and their reporting. We know there was a slowdown in digital ad spending as companies went into hibernation and reduced their external outlays as they tried to navigate during the pandemic. And so this affected growth and spending on Appen's products, particularly for some of their key clients with the mega cap technology names. We know that Appen, as a result of these difficulties, has provided some new strategic lenses. They're transitioning from a primarily services-based business to a product-led business. They believe this will give them better, more consistent and sustainable revenue streams moving forward. Diversifying out these revenue streams and customer base, of course, takes time. These things don't happen overnight, and in the initial transition period, there can be some difficulties. But over time, ASX APX is hoping that this is going to be a much better and more sustainable growth pathway over the longer term. And they also have developed out a new reporting framework and a structure. So it'll be fascinating to see how the APX story heads. Kogan, ASX KGN were one of the true beneficiaries of the stay at home, the work from home, the lockdowns, and investors being forced into online e-commerce, online trading and online purchasing. Many of the e-commerce companies as well as the BNPL companies were beneficiaries of this trend, and Kogan really led that light. However, we know that throughout the past year, there was some over-ordering, really extrapolating out demand that unfortunately did not service, as demand really moved back to a more normalized set of conditions after the lockdowns and as people moved back to a more reopened economy. This resulted in an inventory surplus for Kogan. Ultimately, that affected costs and their margins and profitability. The competitive landscape does continue to develop in the e-commerce field. We know that online penetration is still in its very early stages, particularly in Australia compared globally, but also globally in comparison to where it's likely to be in 2025 or 2030. And so this provides a great opportunity as the pie continues to expand for companies that are able to take market share in this space. It's going to be fascinating to see if KGN can be one of these beneficiaries. We know there are other players that are entering and other players that traditionally had more in-store focused offerings, such as your Adair Beauties or your Harvey Normans or JB Hi-Fis, have started to transition online. So it'll be fascinating to see how this dynamic plays out. And of course, we'll be watching for developments surrounding demand as life begins to normalize. Redbubble, ASX RBL, is another company in a similar type of cohort to Kogan. They're an online retailer. We know that they provide the opportunity for artists and creatives to sell their goods and sell their designs online. They have announced a new medium-term strategy with their new CEO, Michael Ilczynski, to focus on top-line growth over the next few years in the short to medium term, and then focus on profitability and the ability to really amplify that growth and leverage scale to drive margin uplift moving forward into the middle of this decade. There, of course, have been questions surrounding e-commerce demand, as we talked about with Kogan. Redbubble is definitely a company that benefits from flywheel effects as it continues to scale. As more artists come online, customers may come online because they see the level or the quality of designs that are there, and they're interested by that. As more customers then come online interested with the possibility of designs, it's likely to see more artists flock to Redbubble as a place that they can sell and monetize their designs. So over time, as they continue to scale, focusing on that top-line growth, it will be interesting to see how it plays out. You can see here in terms of the numbers, Redbubble, of course, was a true beneficiary last year with the ordering online, but particularly because of the designed masks that customers were able to have. We can see here there was a large contribution, up to around 10% of the contribution for total FY21. And so as a result of that, demand's starting to normalize, and now it's able to resume back on a new normal trajectory from FY 2022. Sezzle, ASX SZL, we've talked already about the demand increases that happen from online purchasing, and Sezzle is a company that was a real beneficiary, as well as many of the other buy now, pay later companies that became household names throughout 2020. We have seen across the broader technology cohort on the ASX and globally, valuation compression. This has happened not only in the buy now, pay later sector more broadly, as well as the broader tech sector, and Sezzle hasn't been immune to that. There have been discussions for the BNPL sector surrounding increased regulation and competition, the potential effect that that may have on margins, as well as the market. But it's going to be fascinating to see how it plays out. Sezzle have got a near-term catalyst, potentially through 2022, with a discussion surrounding their US IPO, the capital injection that will bring for them, but of course the exposure to the broader US market as well. And I think it's worth noting that Sezzle, along with the other buy now, pay later companies, have continued to grow that top line. But now it's much more a question about the valuation and the multiples that investors are willing to pay for companies in the technology scene. And this has happened much more broadly than just BNPL. And then Nuix. ASX NXL truly was one of the hottest ASX technology IPOs to come to market in the past couple of years. There was discussions or comparisons with a global company like Palantir. And it was interesting to see the amount of excitement and exuberance that really flowed into Nuix from their float. However, over the past period, there's been concerns about the IPO valuations and about governance. There's been an overhaul in terms of the discussion on that front, and Nuix is really hoping to restart this next chapter into 2022 with a blank slate. Along with that, Nuix was priced like a growth stock. There was some lofty multiples attached to them due to the discussion surrounding the IPO and the prospectus. However, as we can see over this past period, Nuix really has seen some stagnating growth. The top line hasn't grown all that much, and so they've seen a compression in terms of their valuation as a result, coming down from a growth stock, moving much more to a more moderated type of valuation that investors have been attributing to them. I think it is worth noting that underlying the proposition for Nuix, they still do have a world-class technology as well as a world-class client base. But of course, there are a lot of headwinds for them to navigate as investors try to reassess how they should be valuing ASX NXL. It's been a fascinating year in 2021. There's been ups, there's been downs, there's been lefts, there's been rights. Before exploring what could happen up ahead, if you have enjoyed this video, don't forget to hit the like button. Feel free to share it out. As mentioned, we make daily videos each and every day, so if you haven't yet, make sure you've subscribed and turn your bell notifications on so you won't miss any of those. The year up ahead has definitely got some uncertainties, whether it's the fiscal stimulus or the monetary policy side, whether we're considering what a speeding up of the taper or potential rate hikes could mean. Inflation is still here, we haven't escaped that narrative yet, and of course what a raising interest rate environment could mean for valuations, particularly as we've discussed many technology names today. However, on the other side, we do believe that supply chain bottlenecks are likely to ease over this next period, which could flow through to inflation. And underpinning that all, there is a robust and strong economic recovery. The economic recovery has been stronger than many people would have anticipated. And so all eyes will be on 2022, looking at many of the individual company names, those that have succeeded or those that might have the opportunity for recovery. And I'm keen to know your thoughts on it all. So drop in a comment below what companies you've got on your watch list for the year up ahead. Thank you so much for joining us. Have a safe and well Christmas and New Year period, and we'll speak to you soon. For now, stay well and happy investing.